Welcome to the Deep Dive. Today, we're really getting into the weeds on the latest earnings call from Stranding Company.
That's right. Our job here is to, unpack that call, pull out the crucial bits, and give you a clear view of their Q1 2025 and what they're expecting down the road.
Okay, let's jump right in. Q1 2025 is done and dusted for Strand, and yeah, the top line numbers definitely make you look twice.
They certainly do. They reported revenue around $28.7 million for the quarter. And the big story is that year-over-year comparison up 52.4%. That's huge.
Over 50% revenue growth. Wow. Okay. And gross profit followed suit.
Pretty much. Gross profit grew 51.1%, landing at about $8.5 million.
Okay. Strong growth there, too. Now, there was a net loss, though, right?
There was, yes.
Nice.
About $0.4 million for the quarter.
All right. So we've got this really impressive growth on the top line, strong gross profit increase, but still ending with a small net loss. Although slightly better than the loss last year, which was, what, $0.5 million?
Correct. An improvement, but still red ink. We definitely need to explore the drivers behind that loss. But you have to say, starting with growth over 50%, well, that's a powerful signal.
So where did all that revenue growth actually come from? Was it just one thing?
No, and that's what's interesting. It was really a mix. They pointed to solid organic performance from their core business.
Yeah.
And then a big chunk came from the Gander Group acquisition, which they closed back in August 24.
Okay, let's break that down. The core Strand part.
Yeah, the core Strand segment grew organically by 11.2%. That brought it to $20.9 million. And management made a point of saying this happened while a lot of their competitors were actually shrinking.
11% organic growth when others are contracting. That really does say something about their position in the market.
It does. And then the SLS segment, that's the old Gander Group business, kicked in about $7.8 million. That segment obviously had zero revenue in Q1 last year, so it's all additive from the deal.
Makes sense. So core growth from keeping existing clients happy, spending more, plus new wins, and the SLS boost purely from the acquisition itself.
Exactly. It's a two-pronged growth story right now.
Okay, let's look at that gross profit again. $8.5 million total, which is 29.6% of sales. Last year was $5.6 million, 29.8% of sales. So the overall percentage margin ticked down just slightly.
Yeah, just a tiny bit, from 29.8% down to 29.6%. And they were clear that slight dip in the overall number is because of Gander Group.
Ah, the acquisition effect.
Right. The acquired SLS business just runs at a lower gross margin than Strand's historical business.
Yeah.
So when you blend them, the average comes down a little.
That makes sense, initially anyway. But the really positive sign, I thought, was what happened with the core Strand margin.
Exactly. That's the key takeaway here, I think. The core Strand segment's gross profit margin actually increased. It went up to 32.4% in Q1 25 from 29.8% in Q1 24. That's a significant jump.
So the original business isn't just growing, it's getting more profitable on a percentage basis.
Right.
That's great.
Definitely. Now, the SLS segment margin was 21.8% in Q1, and they did say they're actively working on bringing those SLS margins up, getting them closer to the Strand profile over time.
And just in dollar terms, the Strand gross profit was up $1.2 million to $6.8 million, mostly from higher sales.
Offset a bit by cost of sales.
Right. And SLS added $1.7 million in gross profit, purely acquisition related.
Correct. Now, shifting over to operating expenses, OPEX. In dollars, they jumped up quite a bit, up 43.6% to roughly $9 million from $6.3 million last year.
Okay, that's a big dollar increase. But relative to sales, there was a different story, wasn't there?
Precisely. And this is important. While the absolute dollars went up, operating expenses as a percentage of sales actually went down. It fell to 31.4% from 32.4%.
So they're getting leverage. Revenue's growing faster than those costs.
That's the idea. It suggests, improving operational leverage. A good sign for future profitability if they keep scaling.
So what was pushing the dollar amount up so much, particularly in the core Strand segment?
They called out a few specific things. Costs tied to rolling out their new NetSuite ERP system. That was a big one.
Okay.
Then costs related to the Gander Group deal acquisition and integration expenses.
Still working through those.
Yeah. And also significant legal and accounting fees connected to that big re-audit of their past financial statements.
Ah, right. So it sounds like a good chunk of that core OPEX increase might be related to these big, maybe one-off or transitional projects, not just like run rate spending increases.
That seems to be the case. Of course, the SLS segment OPEX increase was simply because they acquired the business that wasn't there last year.
Okay.
And tying this all back to the bottom line, that roughly $0.4 million net loss It's basically the result of that strong gross profit growth being offset partially by these higher operating expenses, especially those project costs.
Got it. Okay, let's move off the income statement. What about the balance sheet, liquidity at the end of Q1?
Look pretty solid. They reported about $12.2 million in cash equivalents, and investments. Total assets were sitting at $52.2 million. Stockholders' equity was healthy at $31.3 million. And importantly, no long-term debt.
Right, no long-term debt is good, but didn't the cash balance drop quite a bit from the end of 2024? It was over $18 million then, wasn't it?
It was, yes, down about $6 million. And they knew people would ask about that, so they explained it quite clearly on the call.
And the reason was?
The main driver was a $5.1 million decrease in something called their rewards program liability.
Rewards program liability. Okay, what does that actually mean?
Yeah, it's specific. It's for a loyalty program they manage for one particular client. Strand basically holds cash from that client, ring-fenced, specifically to load onto prepaid debit cards that go out to the client's customers.
Ah, okay. So the cash going down wasn't because they were burning through it in operations.
No, that's the crucial point they made. It wasn't operational cash burn. It reflects them executing that program. They sent out roughly $5 million worth of funded cards, so the cash held for that specific liability decreased.
So it's more of a balance sheet structure thing for that program.
Exactly. And they also mentioned they've actually received more capital for that program since the quarter ended and expect the balance to spike back up in Q2 as they reload funds for the next round of cards.
Okay, that's really important context for understanding that cash number. Good clarification. Let's switch to some of the strategic stuff they talked about. The re-audit completion sounded like a big deal.
Oh, huge. You can tell they were relieved to have that done. A re-audit, for anyone unfamiliar, it's a major undertaking going back, restating, re-auditing past financials.
Right.
They said it ate up a ton of internal time and cost millions, especially in 2024.
And some of those costs were still lingering in Q1 25.
Yeah, they flagged about $800,000 in legal and accounting costs in Q1 that related back to compliance work for the re-audit from prior periods.
But the expectation is that those specific costs should taper off now.
That's what they said. They expect them to decrease significantly through 2025 as they get into a more normal rhythm with their teams and the auditors.
Getting that project off their plate must free up a lot of management focus.
Absolutely. They basically said, look, re-audit's done. Now focus is squarely on growth, improving margins, and building shareholder value.
Another big piece was the NetSuite ERP implementation. They seemed pretty excited about that.
Yeah, they called it a game changer and confirmed it went live successfully in January.
What does game changer mean in practical terms for them? What's it actually doing?
Well, they talked about automating workflows, which is always good, getting real-time visibility across the business, centralizing control over processes.
Okay.
Fundamentally, they see it boosting their ability to scale up efficiently. It should make them faster, more accurate in responding to clients, just tighter operationally overall. Sounds like critical infrastructure for where they want to go.
Right, building the foundation to handle more business. And the Gander Group integration, how's that progressing?
Also moving along.
Yeah.
They said it's bringing, real scale, helps diversify their business, and opens up a lot of cross-selling potential.
Any specific areas they highlighted?
Yes. They mentioned it gives them a much bigger presence in hospitality and gaming, those verticals, and it brings in new revenue channels through Gander's existing client relationships there.
Are they actually seeing synergies yet, or is that still mostly on the horizon?
No, they said they're already seeing some early wins, synergies in sourcing, logistics, client engagement, and they think there's quite a bit more potential to leverage the combined platform going forward.
Okay, so internal operations improving, integration moving ahead. What about the bigger picture, the macro environment, especially tariffs? That's always a hot topic.
Yeah, they definitely addressed it. They positioned themselves as being proactive, highlighting their experience in managing complex global sourcing already.
So what's the plan to handle the uncertainty around tariffs, especially with China?
The main strategy is diversification. Accelerating it, actually. They're broadening their manufacturing footprint more in the U.S., Vietnam, Cambodia, Taiwan, India, Bangladesh, other places too.
Spreading the sourcing bets around.
Exactly. And their sourcing teams are constantly negotiating with suppliers across this wider network to try and optimize pricing, keep clients happy, but also protect their own margins.
And the number one goal through all that complexity
is still delivering continuity, value, and quality for their clients. They did give a little color, mentioning that direct imports from China are currently less than 20% of their total business, so the direct impact is somewhat contained.
Although those tariff rates can swing wildly, can't they?
Oh, definitely. They used an example. Rates on Chinese cars went from like 145% down to 30%. It's very fluid. But interestingly, they said the process of negotiating with customers and suppliers about how to potentially share tariff impacts is actually, in some ways, strengthening those relationships.
That's an interesting angle, collaboration in the face of uncertainty.
Yeah. And they also made a technical point. The tariff usually applies just to the product cost, not freight or the factory's profit.
Yeah.
So the effective percentage hit on the total cost to the customer might be less than the headline tariff rate.
Okay. What about inventory? Did they talk about that in relation to tariffs? Sometimes companies build inventory ahead of expected tariffs.
They mentioned inventory was up, but they framed it as mostly a positive sign. Said over 90% of their inventory is typically committed to specific customer orders, not speculative builds.
So the increase wasn't primarily about front-running tariffs.
Correct. They described it more as part of their normal business rhythm, tied to fulfilling those committed orders, though the sourcing diversification is happening alongside that.
Okay. So looking forward, what are the main priorities for the rest of 2025?
Pretty clear messaging there. Accelerate organic growth, keep expanding margins, and drive sustained profitability.
How?
Through disciplined cost control, streamlining workflows further, and really leveraging that scalable infrastructure they've built, like NetSuite.
And they feel the market opportunity is playing to their strengths.
Absolutely. They see companies increasingly focused on brand visibility, customer engagement, loyalty programs, all areas they feel uniquely positioned to serve now with their expanded platform and capabilities.
Okay. And just quickly, any update on the share buyback?
Yep. They reminded everyone the board authorized $10 million initially. About $6 million was still available at the end of Q1.
And they plan to use it?
Yes. They confirmed they plan to get back in the market and buy shares once their trading blackout window opened, which was the week after the call.
Yeah.
Obviously, subject to the usual rules about windows and trading volumes.
Got it. And one final detail, they mentioned a change in how they'll report numbers going forward.
That's right. They plan to start providing adjusted figures. The idea is to separate the ongoing operational expenses from some of those potentially one-off costs. We talked about the re-audit, the acquisition integration, the ERP rollout.
To give a clearer picture of the underlying performance.
Exactly. They said a draft framework is almost ready, just going through compliance reviews to make sure it's accurate and quantifiable. And this will include introducing adjusted EBITDA reporting as well.
Okay, good to know. More clarity is usually helpful.
All right, this brings us to our This Is Not Financial Advice segment.
Now, normally here we might discuss some, let's say, creative interpretations or potential trade ideas stemming from the call.
Right. But based on the source material for this specific deep dive, there weren't really any explicit trade ideas discussed on the call itself.
So we'll have to skip the outrageous but plausible trade idea for today. We stick to the source.
Stick to the source. No speculation here.
Okay, so let's wrap up our deep dive on Strand Company's Q1 2025 earnings call. What are the main takeaways?
Well, first, clearly a quarter marked by really strong growth, driven both organically in the core business and significantly by the Gander Group acquisition. That 52% top-line jump is the headline.
Right, and we saw signs of improving operational efficiency too. Core segment margin expanding, OpEx as a percentage of sales decreasing.
Even while they were absorbing those big, potentially temporary costs from the re-audit and the NetSuite implementation. That shows some underlying strength.
Plus a solid balance sheet, no long-term debt, and that important clarification on the cash movement tied to the loyalty program liability, not operational issues.
Yeah, that was key context. And looking ahead, their strategic priorities seem very clear. Accelerate growth, expand margins, keep improving operations, and manage the tariff situation through diversification.
And it really feels like getting the re-audit done, launching NetSuite successfully, and making progress on the Gander integration. These are the building blocks they see, enabling that future performance and scale.
Definitely seems that way. Now, just the standard reminder, this discussion was purely for informational purposes. It is absolutely not financial advice.
Always important. So, as you think about everything we've unpacked from this call, maybe here's a final thought to consider. With the re-audit finished, the potential efficiency gains from NetSuite starting to kick in, the Gander Group integration moving forward, and that strategic sourcing diversification. How might all these pieces coming together impact Strand's overall margin profile and maybe their growth path as we look towards the second half of 2025 and into next year? Something to mull over.
Thank you for joining us on this deep dive.